Everybody, thanks for coming. As usual, the rules are feel free to break in with questions normally as you would during a seminar. We'll also leave the stream open at the end for more discussion and just kind of chit chat if you're interested. Next week, we will have on the 20th will be Isabella Mejan talking about search frictions in international goods markets. The week after that, on the 27th, will be Gabriela Mundaka talking about carbon pricing and international transport fuels. So that's what's coming up. Today, though, we have Carter Mix talking about technology, geography, and trade over time. Carter, you have an hour. Go ahead.
All right. Well, thanks to Kim, George, Jonathan, and Sam for inviting me to talk on this seminar. Some of you may have noticed the title, Technology, Geography, and Trade, is actually an homage to work by Jonathan and Sam. Technology, geography, and trade, introducing kind of set a standard for what a multi-country model evaluate and give trade policy should look like. I'm adding this over time because I'm thinking about how firm export dynamics affect macroeconomic outcomes in multi-country models. And of course, George have made significant contributions in that literature about firm and exporter dynamics and trade policy. So I think the paper is very well suited to the seminar, and I'm happy to have the chance to present it in front of so many people that are so knowledgeable about this topic. So the main goal of this paper is to try to develop a model that can better explain aggregate export behavior and macroeconomic dynamics after changes in trade policy. And when I say a model that can better explain, there's two observations about trade policy and trade that I hope to capture in the model. The first is that many changes in trade policy are not global and should therefore be studied in a multi-country trade model. So I'm thinking about regional trade agreements, more recently regional trade disagreements like the U.S. China Trade War and Brexit. All of these are changes in trade policy that involve only a subset of countries, but for which the effects of those countries depend on future response in the rest of the world. And countries that are not directly involved in the trade policy can also be affected because of substitution in trade and other factors.
Oh, hold on,
just a second. Yeah, go ahead, Sam.
Your sound was breaking up, but I just didn't know if it was you or whether it was me. But
is that?
Yeah, I think everybody.
I got the same thing.
Yeah, everybody.
Okay, let me try this without the headphones. Does that sound better?
Or you may want to get the kids off the internet.
Does it sound any better now?
Yeah, that's better.
Yeah, I mean.
Right now, yeah.
All right. Right. So the first thing, many changes are not global, and we need a multi-country trade model. The second point is that because trade policy acts on the economy through trade, if we care about the transition of the economy after changes in trade policy, then we better also match the transition in trade. And a key component of that is having exporting decisions by firms that are destination specific and persistent. So recent work by Morales, Zhu, and Zoller and McCallum argue that there's an upfront cost to exporting to this destination. Now there might be some mitigation of these costs depending on behavior where you've exported in the past, but there's still this destination specific component to costs that is important for the export decision. So in terms of the literature so far,
Hey Carter. Hey Carter. Yeah, you're still a choppy. Maybe try turning off your video to save some bandwidth.
Okay.
And there's also, yeah, try that. So just in the bottom left-hand corner, just stop your video, but you'll still be able to share your screen.
Do I have it on here, or do I need to?
In the bottom left corner of your screen should be a button, then you can just choose stop video.
I think I have to stop. Oh, here it is. Okay, got it.
Oh, maybe it's okay.
Yeah.
Does that help too?
Okay, does that work better?
You sound good right now. We'll see. When you sound good, you sound good. Then sometimes you get broken up.
I can change to a hotspot or something if I need to. But let's try this.
Okay.
All right. So what's the current status of the literature? Well, there's multi-country trade models that follow along the lines of Jonathan and Sam's work, and these are really good at capturing the first observation. looking at asymmetries in countries, and how those matter for the effects of trade policy. But oftentimes we're looking at the changes from one equilibrium to another with no sense of transition. And if there is a transition, then it's in maybe capital or some other source of dynamics, but the trade adjustment is immediate. Okay, I'm going to check in real quick. Am I sounding okay? Okay. Then there's this second literature to which Kim and George have made significant contributions, and also Joe, who's on right now, and several others who are on, with two-country models, Joe has a couple multi-country models that focus on the exporting decision, the persistent exporting decision, which helps us to generate the slow growth in trade. But of course, because these are generally in two countries, we miss out on these in trade policy that are not global. We're very limited in the scope of the trade policies that we can analyze. Now, I just mentioned that Joe actually has some multi-country trade models, and Joe and I have a slightly different setup in the model, and so this is going to be a slightly different approach. But the goal is to come up with an approach that can address both of these observations to understand the effects of changes in trade policy. So to that effect, hold on, let me get this back up full screen.
Are you still there, Carter?
Yeah, I'm here, sorry.
Okay, just checking.
Okay, there we go. Sorry, I was having trouble with my screen. All right, so to that effect, I'm going to develop a multi-country model with durable and destination-specific investments in exporting capacity. I'm going to build the model on top of an international real business cycle model. And so in addition to the dynamic exporting decision, I'm also going to include other dynamics, including capital accumulation, non-contingent or risk-free bonds that can be internationally traded. I'm going to allow for free entry of firms, so there will be firm dynamics. And then also, I'm going to account for the trade composition between regions or countries in the model. So some regions are going to trade more intensely in consumption, some in investment, and some in capital goods. A key selling point of the model is that despite having all these features, it's going to be quite tractable. And I'll be very clear about the assumptions that I'm going to make in order to keep the model tractable. So immediately, I mean, writing down the equations for a multi-country model is easy. The question is whether or not it's useful for macroeconomic dynamics or export dynamics. And so the first question that I kind of have to deal with is how to calibrate the export decision for so many destinations. Just like in the two-country literature, I'm going to rely on micro facts about export churning. But instead of thinking about export churning to the export market as a whole, I'm going to think about destination-specific churning and whether that varies systematically across destinations. The second question then is, what are the aggregate implications? And I'm really going to be focusing on how this destination-specific export churning will relate to short-run and long-run dynamics after liberalizations. So to give you a preview of how this works, I'm going to look at Mexican exporter level data and show, which is consistent with the literature I cited earlier, that export churning is low at the destination level. In other words, new exporters tend to contribute very little to bilateral exports. The new part of the micro facts, though, is that there is systematic variation across destinations. Major Mexican export destinations have lower export churning than minor ones. So to put that another way, new exporters to a minor export destination like Norway for Mexico contribute much more to total bilateral exports to Norway than do new exporters to a country like Colombia, where Mexico exports a lot. I'm going to pin the model to that observation, to that positive relationship between export persistence and export volume. When I do that, the model delivers some aggregate predictions, namely that for an identical liberalization with a minor export partner, to which you export very little, or with a major export partner to which you export a lot, the model will predict that exports to the minor export destination will grow faster and more than exports to major destinations. And the one sentence intuition for that is related to this larger contribution of new exporters. The extensive margin, which is the key driver of export dynamics in this model, is going to grow faster because there's a larger contribution of new exporters in minor export destinations. Then the question is, of course, whether the export behavior, the aggregate export behavior in the model is consistent with the data. So I'm not going to be able to exactly match the types of experiments I'm doing in the model, but I'm going to do what I think is kind of the next best thing and think about Bayer-Bergstrand type regressions that compare bilateral export behavior after free trade agreements between countries. And in that case, I'll show, well, or I'll argue that the predictions from the data are consistent with, the predictions from the model are consistent with the data, that bilateral exports to minor export destinations grow faster after free trade agreements. Given that we now have this model that can kind of better explain export behavior, then the question is how this affects aggregate we care about. So I'm going to be thinking about how the variation in churning matters for aggregate outcomes. I'm going to consider a global liberalization where all tariffs go to zero from their current level. And what I find is that the welfare gains from that liberalization are larger when we match the churning by destination. If instead churning is uniform across destinations, so we still have the low churning, but churning is uniform across destinations, we have much lower welfare gains and larger through the aggregate trade.
Hey, Carter, you're breaking up again.
You know what? Sorry, this is crazy. I'm going to try a hotspot here.
Okay.
Okay, connected network. Let's try this. Oh gosh. Helps. Okay. And that's to consider discriminatory tariffs. I'm going to think about the U.S. China Trade War. And what's nice about this model is we can actually map out the trade substitution and transition. We know, or the theory tells us that tariffs are going to inspire U.S. consumers and firms to substitute away from Chinese goods and towards goods from other countries. And what's nice about this model is we can actually look at the transition away from Chinese goods. So I'm gonna focus on that part of it. The roadmap going forward, I'll show you the equations of the model. Then I'll talk about the calibration and model fit. In terms of calibration, I'll be showing you this micro fact about the relationship between export persistence and export volume. And then in terms of the model fit, I'll show this macro fact about the export responses across destinations. Yeah, am I sounding better on this network?
So far.
Right. Okay. And then after that, I'll talk about welfare and aggregate dynamics. Okay, before I go into the equations, just let me give you a brief outline of the model. So each country will have a representative consumer that chooses consumption, labor, investment in physical capital, and investment in the risk-free bond that they take into the next period. In addition to income from labor and capital renting, they'll also receive profits from firms and also a tariff rebate. I'm not going to show you the actual setup because it's very standard. Then there's final goods firms that produce consumption, investment, and material input final goods. They use as inputs for final good production home and foreign intermediate goods, and also domestic labor. And the aggregation of how you use home and foreign intermediates and domestic labor will differ by end use. So consumption goods in particular are going to use more domestic labor, and that's to match gross output to value added shares in the data that are different for every sector. Finally, we have intermediate goods producers. There's a continuum of these in each country that compete monopolistically, and they choose their export status to each destination. As inputs, they use capital and labor, which are rented from the firms, and material inputs bought from final goods producers. They make destination-specific exporting decisions subject to a fixed cost that they have to pay in order to export to a destination, and this is going to be heterogeneous across firms, and variable costs in the forms of tariffs and goods-specific iceberg costs. The goods-specific iceberg costs will help us pin down the composition of trade between regions. The big part that makes the decision dynamic is that incumbent exporters will end up in the calibration paying smaller fixed costs to export to a destination than new exporters on average. So what that means is that an exporter to Canada today is more likely to export to Canada tomorrow than a firm that did not export to Canada today. These firms survive with probability NS, and there's free entry of firms that can replace them. All right, so let's just go over the final goods problem really quickly. There's 3 different final goods sectors. So firms are producing consumption, investment, or material goods. The aggregation of these goods starts by having import bundles. So GJI is the imported intermediates, a bundle of imported intermediates from country J to country I. And it's a CES aggregation of individual firm exports from country J with elasticity of substitution theta. GI, so this is final good production, is a Cobb-Douglas aggregation between a bundle of intermediates and domestic labor. And the weights on the Cobb-Douglas shares depend on the type of good, as I mentioned before. The elasticity of substitution between imported bundles is gamma. Okay, I'm getting a thing that my internet connection is unstable. Are you still hearing me okay?
Yeah, you're actually doing okay right now.
All right, then I'll keep with it. Let's power on through here. So the problem for these firms is to maximize current profits. You get some revenue from selling those goods domestically. You pay for intermediate inputs, which are subject to tariffs tau JI if they're from another country, and you pay for domestic labor. All right, so the intermediate goods producers problem. Again, let's start with the production structure. They produce intermediates using capital, labor, and materials, and production is constant returns to scale in Cobb-Douglas across the 3 inputs. I'm assuming that firms are homogeneous in productivity within a country. So all firms within country I have productivity ZI. So these firms are monopolistically competitive, so they take as given the demand function from the demand from final goods producers, which is from this equation. And they have this constraint that their total exports with the iceberg costs that are good specific, psi GIJ, excuse me, have to be equal to the amount that they produce. Firms are differentiated at the beginning of a period by the export status vector. So for each destination J, they have EIJ equal to 1 or EIJ equal to 0, and by their fixed costs that they draw for that period. And the fixed costs are drawn from a distribution that depends on their current export status. So if they are currently exporting to Canada, then they'll draw their fixed cost for Canada from F1. If they're currently not exporting to Canada, then they draw it from F0. And again, in calibration, we're going to have that the exporter distribution is first order stochastic dominated by the non-exporter distribution. All right, so the problem they have is to maximize the expected discounted value of profits. So in each period, they get some revenue from each country that they currently export to. And if they decide to export to other countries in the next period, then they pay this fixed cost denominated in labor. They have to pay for labor, renting capital, they pay for materials, and then they have some future value that depends on the export status today. And the fixed costs that they draw in the next period will also depend on the export status that they chose today for each destination. So when you are choosing whether or not to export to Canada, you're taking into account that not only will you get more revenue from exporting tomorrow, but you also have a higher chance of being able to continue to export going forward. This is the dynamic part of the exporting decision.
Can you tell us a bit more about how they're discounting the future?
Sorry, can you say that one more time?
Can you tell us a bit more how they're discounting the future?
Oh yeah, so this Q, right, so this Q is the subjective discount factor. NS is the probability of survival.
So is this constant? I mean,
you mean the Q?
Yeah, the Q.
The Q is the subjective discount factor, so it takes into account the marginal utilities of future consumption, the expected marginal utility of future consumption.
It's just you don't have any states attached to it, so it's a bit confusing there.
Oh yeah, kind of for simplicity, I didn't write down the whole state space, but yeah, there's these aggregate state variables that I'm not including here. So. All right, so that's it for the intermediate goods producers problem. They die with probability 1 minus NS, and that's the same, for simplicity, I'm assuming that's the same for exporters, non-exporters, everyone dies with probability 1 minus NS. And new firms can enter by paying a fixed cost FE in labor units. So the free entry condition equates the cost of entry, which is the wage times FE, times the expected profits for an exporter. So this is the probability that you survive, discounted by the subjective discount factor. And then you have this is the value of being a domestic producer in the next period. And you also get the value of starting out as a non-exporter to every destination except the domestic one in the next period. All right, so I made up a lot of assumptions here. So this slide is all about being very forthcoming with the assumptions I'm making and why I'm making them. So I've assumed that all firms have the same productivity within the country. I've assumed that production is constant returns to scale and that all inputs are freely adjustable. What this gives me is that conditional on the same export decisions, firms make the same choices on inputs and prices. That by itself is not particularly important. I could have different, I could get rid of that part. But the big thing is that the decisions are separable across destinations. And that is key, because if we start thinking about an export decision to Russia, depending on whether or not you're already exporting to Canada, then this starts to get really complicated. All of a sudden the state space just blows up because you have to account for every single outcome of the export stats vector for every single firm. So that's the first set of assumptions. The second set of assumptions are about the fixed cost distribution, which is that there are two distributions. They don't change over time, they're IID, and they're history dependent. So the one you draw from depends on whether or not you exported to a destination in the previous period. What this does for us, instead of keeping track of the fixed cost distribution for each destination, I only have to keep track of the number of exporters in each market. And that's easy to do with a law of motion for the number of exporters. So the number of exporters from country I to country J is the number of exporters that survived last period and drew a fixed cost sufficiently low to continue exporting, plus the number of non-exporters from the last period that survived and drew a sufficiently low fixed cost to begin exporting. Okay. Altogether, this makes it very easy to aggregate across firms and keeps the model extremely tractable. But we don't get it for free. The state space is still pretty large in this model. The total number of state variables is I squared plus 2I, where I is the number of countries. So this still isn't a model where we'll be able to replicate what a lot of people do in multi-country models where you have 40, 80, 120 countries. The state space would just be giant. So what I'm going to do is break it up into 6 different regions. So the world will be broken up into the USA, China, the rest of NAFTA, which includes China and Mexico, the European Union, and East Asia aggregate, and the rest of the world. Now, of course, 6 isn't very many countries. So what I do in the paper when I write down the full model, I haven't explained the full model here, but it's in the paper, is that I account for the fact that there's also this dynamic trade decision within a region between countries. The key assumption I have to make in order to model that tractably is to assume that all countries in a region are identical. So then what we do is we add one more state variable that accounts for the number of exporters within a region that are exporting to other countries within that region. So it's kind of a cheap way of getting more than 6 countries, but still keeping the state space low. Here are some parameters.
Carter, can I just interrupt you briefly? Can you speak just a little bit more about what the different, how the model works with and without this within region dynamic trade? Why do we need to incorporate that? What don't we get if we leave that out?
Yeah, so consider a 2-country model because it's simple, where you have like the US and the rest of the world, right? And consider a global liberalization. What you're actually considering in that model is not a global liberalization. You're considering a liberalization between the US and every other country independently. When you allow for trade within the rest of the world, then you can think about tariffs falling also within all the countries in the rest of the world. So it's more accurately a global liberalization.
Okay.
In addition, when you do that 2-country model, you're missing out on how much these countries within the rest of the world rely on trade. Well, you end up getting, it's like, oh, the rest of the world is about as close to the US. But we know that's not true. Most countries are much more open than the US. And so when you do that, a trade liberalization changes your incentives to borrow and lend because it changes the gains from trade that you have from a liberalization. So really it's about correctly understanding the dynamics here and how big the gains are for each of these countries. So then like in your models, Joe, where you're considering like a, Brexit, then maybe it does make sense to have 3 countries, to have the EU, Britain, and the rest of the world, because the rest of the world doesn't have any internal changes in trade policy.
Okay, so it's crucial when you're thinking about a trade policy change that does cause some within region policy changes.
Yeah, that's where there are some small differences outside of that, but that's really the key.
Okay, got it.
All right, so here are the external parameters, some that I have chosen independently of the model. The Armington elasticity is going to be chosen before, which is roughly consistent with some of the literature. This also applies a 1 year. The period is 1 year in the model, so it implies a 1-year trade elasticity of 3, which is roughly consistent with estimates about the dynamic trade elasticity over time. I'm choosing the elasticity substitution between varieties to be 6 to match a markup of 20%. And then I'm not going to go through these in detail, but all these other parameters that match things like the size of the exiting labor share, gross output to value added in different industries or in different sectors, investment, materials, and consumption, and then population in the different regions. All right, so what I haven't told you about yet is how I'm going to calibrate the destination-specific export decision. And I'm going to talk about this now because it's going to be key when I think about the parameters that are dependently and jointly calibrated in the model. So I'd said in the introduction that we're going to talk about destination-specific churning. So using Mexican exporter level data, I'm first going to define the incumbent export share using this formula. And this is essentially the average share of exports incumbents by a destination averaging across destinations. So the way to think about this is you have a Mexican exporter that exports to the US yesterday and only the US yesterday. Then today's exports to the US will be counted in the numerator and the denominator, right? Because they were an exporter yesterday to the US, destination US. But if they also start exporting to Colombia today, those exports are not counted in the numerator, only in the denominator. So this is in some sense, this is actually equivalent to an export weighted average of incumbent shares across destinations. If I then export weight that across years from 2001 to 2009, then I get a value of about 96%, which means that new exporters and destinations account for only 4% on average of bilateral exports. So this is the first fact, that there's very low churning, which in the model is going to be saying that it's difficult to start exporting to a certain destination, but once you're exporting there, it's easy to continue. Now I'm going to consider like a destination-specific incumbent share, which is just given by getting rid of this summation over D, So I'm calculating the incumbent share for each destination. Each one of these dots on this chart represents a single destination. On the left-hand side, I have the average incumbent share for that destination across all years. And on the, sorry, not on the left-hand side, on the y-axis. And on the x-axis, I have the log of average exports over all years for that destination. So here you can see the very strong positive relationship between export persistence and export volume. So like here's the US, Colombia is somewhere in here, Norway is somewhere in here. You can see the strong positive relationship. You can also see this shape that kind of looks like an inverted log, or like almost like a log distribution or an inverted exponential or something like that. Okay, so these are the two facts from the micro features that I want to match. So there's low average churning, but then there's a systematic variation across destinations that depends on export volume. I feel really weird not being, like, I keep talking to the camera, but you guys can't see me. So I don't know if I want to risk turning it on again, but know that I feel very awkward. So the functional form for the fixed cost distribution is going to look like this. For a firm in country I with current export status to any destination N, so N is equal to 0 or 1, this is the CDF that they draw from. And this CDF is not destination specific. If you're an exporter to Canada and an exporter to Mexico, you're going to draw from the same distribution for both. Okay. This little f, F and I, these are scale parameters for the distribution. And these are both country and export status specific. They determine the expected value of the draws given V. So the expected value is F and I over 1 minus V. And so if F0 is greater than F1, which it will be in calibration, then that means that non-exporters draw larger fixed costs on average. V then is the shape parameter, which is going to determine basically how many firms you have on the margin of this exporting threshold for each destination. And this is going to be the key parameter for capturing the positive relationship between export persistence and exports, or in this case, as I've written it here, the negative relationship between churning and exports. All right, so here are the internally jointly calibrated models and the set of targets that I'm matching. Ignore for a minute this last row where I calibrate V. These other parameters can be calibrated to match these targets completely independently of V. We actually don't, we can match these targets for any V. So what I do is these parameters that don't vary by country, we're usually used to calibrating them to match some sort, like a friction elasticity or a labor share. So what I'm going to do is calibrate a symmetric model where I have a friction elasticity of 2, normalize the number of firms to 1, and labor value to value added of 66%. And then I'll take these values from the symmetric model into the calibration for the asymmetric model. In the asymmetric model, I'm going to be matching, let me skip down to this row, the productivity. These are mostly going to be determined by relative GDP of other countries to the US, where we assume that the productivity in the US is equal to 1. And then good-specific iceberg costs are going to help to pin down end-use trade flows. So I'm going to take Comtrade BEC codes, aggregate them into consumption, investment, and material imports, and then match the entire network of trade flow, of trade composition across countries. All right, now let's turn to the parameters for the fixed cost distribution. We have F0 and F1, which again are the scale parameters, and determine the approximate, like the average fixed cost draws. So to determine the approximate location of both of these, I'm going to assume that all countries have a 45% export participation rate. This is kind of a, strange assumption. We know that the export participation rate is going to vary across countries, but unfortunately we don't have really good data to tell us exactly how that relationship works. We don't have data for enough countries to really run a regression and see how that varies. What I can say is that if I change this for different countries a little bit one way or the other, it doesn't matter that much for the aggregate results. So I'm just going to assume that they all have a 45% participation rate. The ratio of F0 and F1 is going to be really helpful in determining the incumbent share, which I'm going to choose to match the data at 97%. All right. Like I said, I could do this for any V, but by varying V, I can get the shape of churning across destinations to roughly match the data. And I'll show you what that looks like in the next slide. So on the left-hand panel here, this is the data for Mexico, when instead of considering all countries as destinations, I'm just limiting it to the 6 destinations that I have in the model, the 6 regions I have in the model. But you can still see this extremely, this strong positive relationship and this kind of unique shape. When we have V close to 0, we can reproduce the range and shape that we see in the data. And then when V is close to 1, we get kind of uniform churning across the model. The reason for this is that when V is close to 0, you have a lot of firms at the margin in each country. A lot of firms that are just barely staying in the market or just barely having to leave the market. So when those thresholds are spread out across the fixed costs, that means that they have very different incumbent shares depending on how much you export to them, depending on how large the cutoff is. When V is close to 1, there's almost kind of like a mass point. Like most firms are drawing very, very small fixed costs. So there's very few exporters at the margin along all these thresholds, and you get kind of this uniform churning across destinations. All right, so we're going to use the calibration with V close to 0, this middle panel. So the question is, how does this micro fact about churning variation in various destinations matter for bilateral exports? Here's the export equation in the model where I've taken logs of everything. So the log bilateral exports from country I to country J depend on variable costs tau and psi. I've gotten rid of good specific costs here just because it's easier to see the intuition. And it also depends on the number of exporters from country I to country J. So one of the key things that differentiates this from other multi-country models is the extensive margin shows up explicitly in the gravity equation. Because the gravity equation is built kind of off of this equation. Then we have these general equilibrium terms, alpha I, which includes changes in the marginal cost for the source country, alpha J, which includes the price level for destination countries, and demand for destination countries. So the static effect from a change in variable costs is the same for all destinations, except for possibly strong, but most of the time very small general equilibrium effects. So the immediate impact on exports is all captured by these first 2 terms. Any differences between countries and any changes in over time come from changes in the extensive margin. The dynamic effect all comes from the extensive margin and IJT. So in the model, if you have more churning, which is again the minor export destinations in calibration, that means that entrants contribute a larger share of total exports in steady state. So after liberalization, you have this big influx of exporters, but instead of having the same amount leave like we had before, we now have more incumbents staying. It all has to do with the curvature at the threshold of the fixed cost, how many people there are at the margin. And so because of that, there's a much faster and larger extensive margin response in these minor export destinations. And since that is the big driver of dynamics in the export, in total exports, you have a faster and larger export response. So here's a graphical representation of what I just showed you in an equation. Consider a global liberalization where I've assumed that all tariffs between all countries, between all regions and within all regions is at 5%. This is U.S. bilateral exports to all destinations. Sorry, this is the change in U.S. bilateral exports to all destinations in the years after the liberalization. So the destination with the highest U.S. exports in steady state is NAFTA. And you can see that the growth in exports to NAFTA is both slow and that the total growth is low relative to other destinations. The destination with the lowest number of exports from the U.S. is China, because remember we're considering like these multi-country regions, and there's this huge trade imbalance between China and the U.S. So the growth in exports to China is really fast and really large. All these other countries are kind of in the middle and are different because of changes in trade composition and all sorts of other things. One thing to know is that the initial impact is the same for most countries. Because NAFTA and the US are somewhat isolated from a lot of the world. There's these strong general equilibrium effects that makes the NAFTA response a little bit different. But for the most part, we get the same static response, which is what I was talking about in the last slide. So instead of just showing you a picture, let me do this more formally.
Can you go back one slide?
Yeah.
So, sorry, this went by a bit fast, but this exercise, what's going on with the interest rates here? Is this an exercise where, you know, these trade costs, these tariffs change, and that affects the discounting, and what are people's beliefs about what's going to happen in the future? I mean,
right. This is perfect foresight. So the tariff decrease is unanticipated today, but then you know that it's permanent forever.
okay. And so what happens to, do you look at what happens to interest rates along this transition in the different countries?
I have not looked at that. I will, that's a good question. Okay, thank you.
Tony, can you go back to the equation you just showed us a minute ago, and can you just try one more time? Yeah, okay. So what is it? I'm looking at this equation, the instantaneous effect. The reason that instantaneous effect is smaller for the NAFTA countries, even though the tau change is the same, is coming from that zeta, I guess it is, term? Or where's it coming from?
It's coming from these general equilibrium effects.
So it's all GE. Okay.
That's all GE. I mean, so you can see that normally the general equilibrium effects are quite small, but a lot of the time, you know, NAFTA's main trading partner is the US, but the US is closed. So this is a much smaller shock for NAFTA than it is for other countries.
Okay.
So, I mean, it's precisely because of that reason that I want to do this a little more generally. So I'm going to think about regressing some dependent variable on initial exports in the model. So this is all using simulated data. So this is initial exports in the steady state. We have a source fixed effect and a destination fixed effect. The first dependent variable I'm going to consider is the growth in exports in the first 10 years after liberalization. Ignore these second two rows for a minute and just look at this top row, which is the benchmark model, the model that I've been introducing to you. And what this says is that if exports, initial exports are high, then the growth in exports is much lower in the first 10 years. This translates to, like, if one destination gets double the trade, then it gets 3.5 or so percentage points more growth in the first 10 years in exports. And then, right, but then of course there's a huge variation in the amount of trade. So some destinations are getting much more than others. And then this dependent variable is saying, well, on the numerator we have the percent change in exports in the first 10 years. On the denominator, we have the total percent change in exports, the long run percent change. So this tells you how much of the long run change is accomplished in the first 10 years. And once again, we have that if you have large initial exports, then you reach the steady state a lot slower. That's what this negative coefficient means. And sorry, I forgot to say, but in the parentheses here, these are t statistics. So these are both, you know, extremely significant in the model. If we look at a model where F1 is equal to F0, so a model where exporting today doesn't give you any advantage in the export markets in the future, we still have a negative and significant coefficient for the growth of exports in the first 10 years, but the magnitude is about, you know, 1/45 the size. So there's really not much of a difference between destinations. And similarly, there's no difference here either in how quickly you reach the steady state. If we consider another version of the model where all firms export, so there are no fixed costs of exporting, in this case, we explicitly withdraw the extensive margin from the export equation that I showed you earlier. So this is like more similar to multi-country models as they stand right now. And here you get absolutely no difference in the growth of exports across countries and no difference in how quickly they reach the steady state. In fact, of course, the response, the adjustment to the steady state is immediate here. So of course, there's no difference between countries. Okay, so just to be very clear, there are 3 aggregate predictions from the model. That if there's an identical liberalization between a minor export destination and a major export destination, then exports to the minor export destination will grow faster, they'll reach their long-run growth faster, and they're going to grow more in the long run relative to exports to a major export destination. So those are the 3 predictions. Then the question is, how do these predictions fare in the data? And here we run into an issue with how do we actually define variable costs. You know, every liberalization has changes in tariffs. Those are, we can measure those, but it's hard to know exactly how we should measure them, whether we import weight, whether we take simple averages. But there's also changes in non-tariff barriers, and there we're a lot more clueless on how we should actually measure, get like an iceberg cost from non-tariff barriers. So I'm gonna do what I think is the next best thing, which is to use the methodology of Byron Bertrand in 2007 and in future papers since, where they use panel data to look at the effects of free trade agreements on bilateral exports over time. The key assumption in their paper, and therefore a key assumption here, is that free trade agreements are the main source of variation in trade costs over time. This paper is going to do a similar estimation as Byron Bertrand, but I'm going to account for whether or not the destination that you sign the free trade agreement with is a major destination, meaning you export a lot to it, or a minor destination. So let destination J be a major destination for country I if it's in the top quartile of destinations in year T. Okay, so Mexico is always a major destination for the US, or sorry, Canada is always a major destination for the US, but some countries are going to come in and out of being a major destination. So here's the estimating equation that I'm going to do. If I get rid of this term with coefficient gamma and this term with coefficient delta, then this is the Beyer-Bergstrand regression. So just talking about Beyer-Bergstrand for a second, what this says is that if you have a free trade agreement that's new in this year that we observe you, the time periods here are going to be 5 years, just like in Beyer-Bergstrand. So if you have a free trade agreement that's new in the last 0 to 4 years, beta 0 is the effect on log exports relative to a country, relative to a destination that for which you don't have a free trade agreement that's new. Beta 0 plus beta 1 then is the effect of having a free trade agreement for between 5 and 9 years on bilateral exports. And then the sum of all betas is the average treatment effect of having a free trade agreement. It's like the long run effect of having a free trade agreement. Okay? We have these source year fixed effects, destination year fixed effects, pair fixed effects, accounting for changes in marginal cost, changes in price levels and demand, and accounting for pair specific variables that don't change over time, such as distance or common language, things like that. So what I'm adding to the analysis is really this interaction term. I want to know not only did you have a free trade agreement with partner J, but was partner J a major export partner when you signed the agreement? Okay. So for major export destinations, the impact effect will be beta 0 plus delta 0. For minor export destinations, the impact effect will be beta 0. So on the next slide, I map out the impulse responses coming from this regression. And you can see that it's different for major in blue and minor in red. So this is the change in log bilateral exports. This is the time, 1 period is equal to 5 years, since the FTA. So the impact effect for major destinations is about a 17 log point in bilateral exports. Whereas the impact effect for minor export destinations is about double that, 34 log points. After 5 to 9 years, the disparity grows even larger. You have about a 40%, a little over 40%, or 40 log point, excuse me, increase in exports to major destinations, and nearly 80 log point increase in exports to minor destinations. And then in the long run, you have very little growth after the 9th year, after 5 to 9 years for minor destinations, but you continue to grow to major destinations. And the long run point estimates, the minor destinations get significantly more imports. So how did our predictions do? Well, it does seem true that in the first 9 years especially, exports to minor destinations grew much faster than exports to major destinations. The second prediction was that minor destinations reached their long run faster. And this also seems to be true, considering that there's barely any difference between the 5 to 9 year range and the 9+ year effect. Whereas for the major destinations, there is this growth in exports after that. And the wall test that tests the difference between these, or sorry, a wall testing whether or not this is less than or equal, so the IRF2 is less than or equal to IR1, is significant at the 5% level. Our third prediction was that the long run effects were different and that minor destinations had more exports in the long run. Here, the point estimates are in our favor. If we do a wall test on this, we get a p-value of about 0.11. Okay? So it's less significant, but the point estimates are still indicative of a difference in the long run. So I'm going to call this a success. Relative to static exporting models, we can explain export behavior across destinations much better in this multi-country dynamic model. And that's all I say on this slide. So given that we were successful in explaining export behavior, now let's go and look at some trade policy experiments and see if we can learn anything else about other outcomes that we might care about. I'm going to be thinking about two trade policy experiments. The first is a global liberalization from current tariffs. So in this one, I'm going to be recalibrating tariffs to meet their 2014 levels. I'll be thinking about how firm level churning across destinations matters for transitions and welfare effects after a liberalization tariff. The second is thinking about this U.S. China Trade War, where I'm going to map the substitution between trade partners over time. I'm going to check my time here. Okay, all right. Actually, I'm going to go a little bit quickly through this because I want to make sure I get to the actual results. So to do a global liberalization from current tariffs, we need to first recalibrate the initial tariffs. I'm going to get a region tariff, tau J, which will just be the GDP-weighted average of individual country tariffs, which I'm getting from the World Bank. Some regions, of course, don't have tariffs. So I'm going to assume that tariffs between US and NAFTA, within the European Union, and within East Asia, which includes a lot of ASEAN countries, assume that they're all zero, and calculate a new region tariff, tau bar J, that makes the tariff inclusive import value from the data and the model equivalent when we assume that there's zero tariffs for FTA countries. So you can think about tau bar J as like a most favored nation tariff. If you don't have a free trade agreement with a partner, then the default tariff that you charge them is tau bar J. Let's compare two models. One is the benchmark model, in which we had this destination-specific churning that varied in the way it did in the data. And the second is this other version I showed you, where churning is uniform across destinations. So this will imply that the liberalizations with minor countries have a much smaller trade response. The welfare gain is the percent increase in initial steady state consumption that makes you a difference between having the liberalization and not having having the liberalization and not having the liberalization. And you can see that the benchmark model uniformly delivers higher welfare gains than in the model that does not account for various destination-specific churning. So I'm going to focus a little bit on China in the next slide. China had a 2% welfare gain. It relies on a lot on trade, and it had high initial tariffs, so it gained a lot more than other countries. And then in the case where destination-specific churning was uniform across destinations, then it was much lower at 1.6%. So let's look at some dynamics for China. The key thing here is trade elasticity. In the benchmark model, it goes from about 2.7 to over 5.5, whereas in the model with uniform churning, it went from 2.7 to just above 4. So the reason for this is exactly what we saw before. Exports to minor destinations are going to grow by less. In this case, this is imports. So other countries' exports to China are going to grow by less if China is a minor destination for them. And when you aggregate that across all destinations, or in this case, all sources, what you end up with is much lower trade elasticity. That trade elasticity also matters for things like capital deepening. We've assumed that trade is intensive in capital. And so that's going to matter, right? So that's going to matter for consumption and output and other aggregate outcomes, as we can see here. So lower long-run consumption, lower short-run consumption in the model with uniform churning. One thing to notice here, if you're familiar with the literature on dynamic exporting, I have much less overshooting than in some of the models that George and Kim have. And that's a result of having endogenous labor decision and capital-intensive trade. If I take out those features of the model, I can match the more severe the more severe shape that they have in their paper. All right, now let's talk quickly about the U.S. China Trade War. So far in the trade war, tariffs have increased about 12.5% between both countries. So I'm just going to assume that that all happened at once and that it's permanent and that there's perfect foresight. So we're going to assume that this trade war is permanent, which, you know, you may have different opinions about that, but this is just what I'm going to do for the analysis. What's cool about this model is that you can actually map out the gradual substitution of imports from China to other countries. So this is U.S. imports from all different countries. On the left-hand side, we have China. There's this first intensive margin decrease as exporters from China export less to the U.S. There's less demand for Chinese goods. But then over time, you have more exporters in other places in East Asia, NAFTA, European Union, that replace these exporters in China. So the number of exporters to the U.S. from China falls over time, and that extensive margin movement also has an effect on the total imports from China. And then the imports from other countries in the world are going to have an initial increase. Their goods are now more attractive and grow over time. This transition is also going to depend on trade composition. In 2014, 36% of imports from China were classified as capital goods imports. The US really relies on China for capital goods. They rely a lot less on these countries for capital goods. So they're going to become much more internal. China's going to become much more, the US is going to become much more closed because they're going to get most of their capital goods now domestically. So the point of this slide is just to show you that the model is very flexible. We consider all sorts of different changes in trade policy. We can think about transitions. And also there's a lot of rich dynamics to be considered when you consider different trade compositions and other factors. All right, so I'll conclude now. What I hope I've convinced you of is that this multi-country dynamic exporting model is a useful tool to explain aggregate export behavior and macroeconomic transitions after changes in trade policy. I hope I've convinced you that because of the ability of the model to match export behavior, this macro outcome that we see in the data, right, and then also how it fits the micro data. Again, a key selling point here is that it's tractable. So I'm going to be posting code over the next couple of weeks on my website, and you know, we've made some strong assumptions, but those assumptions help us to keep a tractable model that we can solve very quickly, and that we can add a bunch of other stuff to. You could think about sector-specific productivities. You could think about all sorts of heterogeneity that I haven't covered in this kind of first step, this first bridge between multi-country models and dynamic models. Just because I didn't mention them in the slides, I want to quickly talk about some other cool applications of the model, which relate to the timing of trade policy. So if you think about a static model, if you have a temporary liberalization, say, or a temporary trade policy, say a anti-dumping duty, right? What you have is that exports are going to fall a lot when the duty goes in place, and then rise a lot afterwards. Here you have this dynamic exporting decision. So the exporters of those goods know that right now the tariffs are high, but if I can stick around just long enough, then these tariffs will go away. So this dynamic exporting decision that's going to change the way that we perceive trade response to temporary trade policies. It also helps in thinking about expectations towards future policies. So George and I actually have a paper where we think about the macroeconomic outcomes of future liberalizations using these types of exporter dynamics. So with that, I will conclude. Thank you for attending the presentation. I'm happy to take any questions or indulge in any discussion. So.
Okay, so let's open the floor up to discussions. I'm going to go first. So first one I think is a simple question, but Carter, if you can go back to your second experiment with the China trade war. What, this I go back, yeah, here. What's driving that pattern of reallocation? Why is it East Asia and the EU that they're substituting for, and not NAFTA or maybe whatever purple rest of the world?
Right. So one thing you have to realize here, these are log point changes. So initial exports to NAFTA are much higher. There's kind of less room to increase imports or imports to NAFTA. So that's one reason for this, is just because you're importing very little from Asia to begin with. or from East Asia relative to NAFTA. And then the other reason, you know, I haven't looked at this closely. This is something I added more recently, but I can look at this more closely and think about precisely why these are different. But I think the main reason I think is because of initial exports being different across the different regions.
Okay, is there?
It might be helpful then to show, rather than, you know, to show a picture that just shows the, maybe like a stacked time series chart or something that shows how the evolution of the import composition changes over time.
Yeah,
rather than just showing the percent changes, because, you know, the percent change from nothing to nothing, even if the percent change is big, doesn't really matter much for the aggregates, right?
These are multi-country regions, so none of these initial trade values are small. They're just smaller than that.
No, I know.
That's one point. My other point is I think percent changes are useful for the following reason. If you consider a static model where all firms export, I turn on my video for this part. Can you guys still hear me?
Yeah, go ahead.
You consider a model where all firms export, then it doesn't matter where you start. The percent change, the log point change in exports is exactly the same. And so it's kind of useful to see how this model actually generates very different changes in percent changes. So I kind of like this representation, though I totally get your point. That would be useful for other reasons. Thank you.
This must also have to do with just what happens to GDP in the different regions as well, as you were talking about before.
Right.
I think it hurts China a lot more than it hurts the U.S., doesn't it?
Yes, that's correct.
That's what Trump says.
Different movements in the real exchange rate, income.
Yeah. So this is actually, I mean, at the risk of like talking way too much, one of the things I want to do with this model later is do a better analysis of the U.S. China Trade War. It's something I was doing with the paper earlier that I've kind of dropped because I want to spend more time on it.
Yes, go ahead.
One of the cool things you have is that like China's big shock is a loss in demand, right? They export a ton to the U.S. The U.S.'s big shock is more expensive inputs. They import a bunch from China, but they don't export a lot to China. So there's these very different impacts based on whether the demand effect is the one that's really important for you or the supply effect. I think all of that, and that all comes from the fact that I've allowed trade in the model to match actual trade flows. So I'm actually matching the trade imbalance between the US and China. Okay, sorry, Kim, go ahead.
No, that's great. And then presumably this is also driving like cross-country effects too, like NAFTA to East Asia, NAFTA to EU. Like, are those just really small and not worth talking about, or?
They're not small.
And that would be interesting to see, right? I mean, or like, presumably there's,
in the other
like,
paper.
are imports from China to like you know, the EU now then getting cheaper, and so they're sending more to the EU than before? Like, it seems like there's these kind of general equilibrium trade effects would be interesting if they're there or not.
Yeah, so they are there, and you've actually hit it right on the head. Because this is mostly a demand shock for China, you get this huge decrease in the wage, which makes their goods super cheap. They export more everywhere after liberalization. The US, on the other hand, their goods become a lot more expensive because their inputs have become more expensive. And so they're going to export a lot less to the rest of the world. So there are these very different dynamics depending on what's happening in these countries. But also, like you said, you know, the gain in terms of welfare gains, NAFTA, East Asia, the European Union do gain from the US and China fighting, because all of a sudden now they're more interested in developing trade relationships with other countries.
Okay.
I don't have
another question about your theme about the exports grow faster and more to the small places than the big places.
Yeah.
It'd be nice if you could somehow make an analogy of that to something. It may be a false analogy, but I just want to throw it out there. Like Tim's and Kim's paper about the faster increase for the goods that weren't traded much beforehand. And then Costas Arkalakis kind of picked up on that. So it was the firms that were just getting going because then they had an extensive margin of new customers. And somehow I kind of feel like yours somehow connects to that, but I'm having a hard time doing that in my head. It may not be true either, but it does seem like something that is going to come to people's mind when they hear this story about small versus large and rapid growing versus slow growing?
Yeah, certainly in the model, that is an important channel, right? All of the growth in exports is coming from the extensive margin. In the data, yeah, I just don't know how true the analogy is because I'm not trying to discover the source of the differences in the data. But I think that's a very good point. I imagine they are somewhat related. Thank you.
Well, it seems like you could run the same Bayer-Bergstrand regressions with some extensive margin data and show us that there's that this also goes through at the extensive margin level.
So George, I don't know if it's the same for everyone, but you're breaking up for me.
Yeah, I think it's on your end because you're breaking up again.
So I was just saying you could run the same Bayer-Bergstrand regressions with some measure of the extensive margin, you know, whether it's products or, I mean, that's pretty much what Kim and Tim did. And we sort of know already that the extensive margin is the source of that growth. It just would be interesting if it was differential as you're finding it in the exports. So.
I lost you for a big chunk of your comment, but I think I got the gist, and you could do this with the extensive margin maybe. Yeah.
I wanted to go back to my question about the asset market and what's going on there. So I was looking at the paper, and I don't know, probably these are just typos, but it's sort of, you've got this at the consumer level, budget constraint. And so that's written in a common, let's say a common currency, and you've got this bond price Q is showing up there, but that's not the Q in your slides.
I may have changed notation from the paper to the slides.
Right. So each country's firms is discounting in a different way because it has a different margin utility of consumption and consumption growth. Okay.
So, but there's the ratio of expected margin utilities is the same. So there's just non-contingent bond. No. No. Okay. So
each. I mean, okay. So the basic model is not stochastic. So you're doing a transition from a steady state where nothing is stochastic to another steady state. Okay, so I'm trying to think about that the growth rate of the margin utility of consumption in steady state, I don't know whether that's equalized across countries. I'm not sure that it needs to be. I have a hard time thinking about that. But certainly along the transition path, since the welfare effects of this should be different depending on how open you are, then those growth rates should differ across countries. And so interest rates definitely along the transition path are going to differ. Whether they differ at the initial steady state, I think that depends on the assumptions you make. I'm not sure.
Okay. Yeah, I don't have an answer for you. And let me I'll look into it.
I mean, there's a Backus-Smith condition in the model, right? So in the steady state, the real exchange rate is constant. So everyone's interest rate should be the same. And then on the transition.
Well, no, that's not true. So in real terms, which is what they're using to discount, I don't think that has to be the case. So that this bond price, this Q, is going to be equalized across countries. That's in dollar terms. But when it comes to real interest rates, the value of a dollar is going to be different in different countries because of their trade costs. The trade costs that they face are going to be different. So if I'm far away from everybody, it's expensive for me to import. So in some sense, the level of the consumption price is going to be high. My ability to smooth consumption over time or across states of the world is going to be different from somebody who's close to everybody and who faces low trade costs. So the interest rates should be different, I think.
I mean, I think if you took like a standard IRBC model and took the trade cost to infinity, like a 2-country, 2-good model, which is essentially that, the interest rates would be the same in the steady state of that model, regardless of how much trade there was.
But if you're taking the trade cost to infinity, we're not able to smooth.
In a limit. No, but he's looking at a not.
But these countries are asymmetric. This is the thing. It's in a 2-country symmetric setting, that's one thing. But his countries are asymmetric. So although they may face the same Q, I'm not sure that they're going to be using the same real interest rates or the same ratios of or growth rates of marginal utility of consumption to discount. The paper by Ricardo Reyes Teroles, so your colleague, I mean, he gets into that and he's thought a lot about that, so he would certainly be useful to talk to about this.
But that's the transition, not the steady state, right?
She's talking about the transition, though.
I mean, there's also potentially an issue in the steady state, but I have a hard time thinking about a non-stochastic world there, so I'm not sure. But certainly along the transition, people are going to be facing different interest rates. And they're going to be accumulating net foreign asset positions along the transition, which are then going to have an impact on the budget constraints that they face at the end. So it's also going to matter what you assume at the beginning for the net foreign asset positions.
Oh, so I think maybe I understand your question a little better. So I'm solving for, basically I use kind of a shooting algorithm to try to figure out what the final net foreign asset position is. And what I'm assuming is that you have some initial net foreign asset position. And in year 1, as soon as you find out what the new trade policy is, then all of a sudden you have some new target net foreign asset position with the same financial friction cost of getting to that steady state. So that's the assumption that I'm making. And this stuff about interest rates along transition or at steady state, that's something I can look into, and I'll talk to Ricardo about it and read up on some things. So thank you.
Okay.
Carter, let me just ask you briefly something about this, the data, the churning data. So having looked into this stuff a bit myself, my sense is that the fact that, that you're finding this really low churning, even in, big Mexican export destinations like the U.S., is probably a bit, in large part driven by the fact that, the size distribution of exporters in these big destinations is really skewed. And this is particularly true for Mexico. So you have these, the vast majority of Mexican exports to, say, the U.S. are done by, just a couple of really, really big firms. And so you actually do have a lot of small exporters moving in and out a lot.
Yes.
So the exit rate is pretty high.
Yes.
At the level, in terms of the fraction of exporters that are leaving and entering back in.
Yes.
And that's less true for other destinations precisely because the export distribution is less skewed. You have exports are done a little bit more evenly distributed across firms, and so when any given firm leaves, they account for a larger chunk of it. And that, that could be true even if the difference in exit rates is, if the exit rate is exactly the same across destination. No, so I think the way that you've set it up works perfectly well. My question is really, does it matter at all for the, at least quantitatively, the effects that you get that the size distribution doesn't play a role in here at all, that all exporters are the same size?
So it could. I certainly don't want to make a claim that it doesn't matter at all. I guess there's a couple comments I want to make on that. The first is that doing this thing with having the same productivity kind of has two advantages.
Yeah, so partly, I also wanted to know, I guess I meant to say this. I also want to know what are the advantages of doing it this way as opposed to doing it with the other kind of more or less standard way of doing it, where you just have the one scalar fixed cost and you have, heterogeneous sizes.
Right, exactly. So there's two advantages that I see. Number one is that when you have this what you said, the scalar fixed and sunk cost and heterogeneous, you induce a sort of hierarchical exporting in the model. A firm can't export to Russia without first exporting to Canada, right? If you're productive enough to export,
of course.
So that's one. This is capturing the fact that you can export to any country.
Right. Okay.
Number two is that what I really care about in calibration, and this relates to the other thing you were talking about, is the contribution of the extensive margin to increases in exports. So while there are different sizes, and as you mentioned correctly, the incumbent exporter share, so in terms of like the number of firms coming in and out, is much lower than the share that I'm showing you, right? Still persistent, still evidence of a persistent decision at the firm level, but much lower than what we're seeing in the incumbent exporter share. But what the incumbent exporter share doesn't match is the contribution of new exporters to total exports.
Yeah, absolutely. That I completely agree.
And so one thing that I do in the paper is I consider, like, you might also think, okay, well, the 1-year contribution is one thing, but maybe what you really care about is the 5-year contribution of new exporters. Like all the new exporters in 5 years, how much do they contribute to new exports? So I do like some things where I recalibrate matching different types of incumbent export shares, but I don't think the incumbent exporter share is the right one for exactly that reason. And also coming back now to the homogeneous productivity, one of the criticisms of these heterogeneous productivity models is that
we're losing you.
Because the sunk cost is higher than the continuation cost, is it improving at all? I don't know. At this point, I don't know what else I can do.
No, at the moment, you're fine. Keep talking.
Because the sunk cost is higher than continuation costs in a heterogeneous productivity model, the new exporters are the most productive exporters.
Yeah.
Right. So that's the other criticism. And then Kim and George have this model where you account for exporter dynamics by having the new exporters pay a higher variable cost. But in that paper, they also show that the dynamics are pretty similar between that model and a model where you just jack up the sunk cost to begin with. And so that's the approach that I'm taking. I'm jacking up the sunk cost income and export share versus something else and accounting for heterogeneous productivities.
Cool.
So, sorry, I missed the first part of your question, so if I didn't address everything, I'm sorry.
No, I think that's pretty comprehensive.
Okay, cool.
All right, any other questions or comments for Carter? Okay, so I think we'll stop the recording.